I think the dollar is really going to drop another 15%, 20%. The reason for that is if you go back to, sorry, if you go back to a couple of months ago, everybody was putting money into the dollar and into US assets because of US exceptionalism. You simply didn't think about it. The US had the growth, they had the low inflation, interest rates were going the right way, lovely. Now you're in a predicament where the US has actually is busy tearing up all the factors that contributed to US exceptionalism. We're going to see inflation from the tariffs. We're going to see further friction between the Trump administration and the Fed, trying to force it to drop interest rates, even though inflation will be going up. And I think people are vastly overexposed to US assets. For instance, in the last decade, about $18 trillion from abroad. So the dollars were bought and then the money was put in US stocks. And the ownership now by foreigners of US stocks is still about 18%. They've sold about 60 billion out of the 18 trillion in the last couple of months. But that process of exiting the US as safe haven and best performing economy is going to be a long duration trend. So much more to come on the dollar.
Much more to come. So, David, let's put some numbers on this. Let's take the lower bound. If it has another, let's say, 20% to fall, and I'm assuming you're talking about DXY here, that means we're talking about DXY yes. ending up at 80, is that right?
Yes, 80, 85, certainly.
And what would that mean for other assets, dollar-denominated assets? I mean, if DXY goes down to 80, what happens to treasuries?
Well, I think the problem there is that part of the going down to 80, 85 is actually that people will be getting out of treasuries. And particularly, I'm pretty sure that the role of the dollar as a global reserve currency is going to have an impact on the treasury market, because essentially the foreign countries which have signed off on the dollar playing that role are now being attacked by the US. So why would they, they won't be getting the same amount of dollars for their exports because the exports will be plummeting due to the trade tariffs, then obviously they have to make a decision as to where they're going to put the remainder of that money. And I think the likelihood is they'll keep it out of dollars. They will look for alternatives to the dollar as a reserve currency. So that also is part of the equation. But the link between treasuries and the dollar is perhaps the most critical one for the U.S.
Yeah, which is why I was very keen to ask you about that tie-in there. So, if down 20% on dollar means that people are going to be selling U.S. Treasuries, where are you assuming yields are going to end up? Are we talking about for the 10-year yield cycle highs of 480, for the long bond 5 or north of that, or what?
Oh, I would say 550. For the long bonds north of that. So I think there's going to be a pretty major reversal, because what's going to happen is the U.S. is going to have an economy which is going to be suffering from durable inflation due to tariffs. So I don't accept that this is yet another transient man sort of syndrome. I think that's going to be proven completely wrong. So you will get the inflation and you will get falling output. So the Fed has to choose whether it's going to fight for its inflation mandate or its employment mandate. And I think a lot of aggro between the Trump administration and the Fed is going to be on public display. Well, if that is the case, I mean, really, treasuries are going to go through. They're going to go through the floor, and the yields are going to go through the roof, because you're going to see inflation up, the Fed cutting interest rates in the end because they've got to, and people saying, well, they're not fighting inflation anymore. And at that point, you really take the hit of the long bond.
David, I forgot what I was going to ask you next, because I'm still lingering on 550. Before we get there, wouldn't the Trump administration do something about it? I mean, Scott Bessent did say in an interview just a few days ago, saying the Fed doesn't have to move. We've got our own toolbox at the Treasury. Would they let it get there, 550?
Well, what are they going to do to stop it? I mean, the only people who can stop it is the Fed by, doing QE again. Well, I've never heard of QE being trotted out as a weapon to use against the result of a disastrous tariff policy. But of course, in this administration, anything could happen. But no, the Fed can do very little about it. It can change the maturities of the bonds that it's actually bringing to market, so that it could do less at the long end and more at the short end. So you've more supply at the short end and less supply at the long end, which might have some marginal impact. But frankly, limiting the damage is not something that is within the powers of the Fed to do. So I would discard that.
All right, so money leaving the dollar, where is it going? Let's talk about that. You did say you're still long the euro, but nervously now. Is it getting a little too crowded?
Well, it's not really that it's crowded. It's that when you look at Europe, and there are an awful lot of other things to worry about. There's the question of the US's new alignment with Russia. What does that mean for Ukraine? Will the Europeans stand up for Ukraine? If so, there will be a break with the US. So there are other sources of volatility which you have to worry about in the euro, which you do not have to worry about if you put the money into gold or into Japan, which would be the primary hedges I would use.
All right. What do you feel about gold right now?
Well, I think the likelihood is that we'll see it about 3,800. Now it's not going to get there in one fell swoop, but I think the reasons why people are buying gold, instability, the possibility of the degrading of currencies and currency management by the US, that sort of thing is still going to be there. So people will go on buying gold. I'd say 3,800.